All right, today we're going to tear down one of the biggest myths in personal finance, the idea that renting a home is basically just setting a pile of your money on fire every month. We're going to look past the whole American dream idea and dive straight into the hidden math that honestly could save you a fortune. Renting is just throwing money away. Come on, you've heard it a million times, right? From your parents, from your friends, maybe you've even said it yourself. It's this bedrock belief that every mortgage payment is like a little deposit into your future wealth, while every rent check just vanishes into thin air. But what if that's a huge and kind of dangerous oversimplification? What if the hidden costs of owning a home could actually make renting the much smarter financial move? That's exactly what we're going to unpack today. So let's just jump right in and challenge that core belief. Is rent really just money down the drain? For a renter, the math feels really simple. Your rent is a pure expense. You pay for a roof over your head, and that's the deal. But for a homeowner, it is way more complicated. Yeah, sure, part of your mortgage payment builds equity, but a huge chunk of it goes to costs you will never ever see again, just like rent. So let's pull back the curtain on these hidden financial dreams. All the money you pour into a home that does absolutely nothing to build your wealth. We call these unrecoverable costs, and for a homeowner, we're not talking about just one thing. It's a whole cocktail of expenses: mortgage interest, property taxes, insurance, maintenance, and this big one that most people miss called cost of capital. These are the things that can make owning a home way more expensive than just the mortgage. Okay, first up, property taxes. A good rule of thumb is to figure about 1% of your home's value paid every single year. This is a pure cost. It builds zero equity. It's basically a subscription fee you pay to the government for the privilege of owning your land. Next, you can pencil in another 1% for maintenance and repairs. Your house, as an asset, is in a constant state of decay. It is literally trying to fall apart. This 1% is just the average cost to keep it from losing value. Think of it as the price you pay to fight entropy. And now for the big one, the hidden cost that almost nobody talks about, the cost of capital. This is about 3% of your home's value, and it's made up of two things. First, the interest you're paying on your mortgage, and second, the money you could have earned if your down payment was invested somewhere else, like the stock market. It's a massive, invisible financial drag. And here's the other thing. Unlike your nice, predictable rent check, home maintenance costs are lumpy. You might go a couple of years with just tiny expenses, and then, bam, you get slammed with a 5-figure bill for a new roof or a busted sewer line. Just look at these numbers. A new HVAC system, that can run you $12,000. A new roof, that could easily be $25,000. And look, these aren't hypotheticals. These are eventual certainties that most homeowners are just not ready for. Okay, so with all these different costs swirling around, how in the world can you figure out which option is actually cheaper? Well, that is where a super simple but really powerful tool called the 5% rule comes into play. It's honestly incredibly simple. You take the value of a house you're looking at and multiply it by 5%. Where's that 5% from? It's our 1% for taxes, 1% for maintenance, and 3% for the cost of capital. That number gives you the total annual cost you'll never get back. Then just divide that by 12, and you get what's called your monthly break-even rent. And this is where it all clicks. Look at this. For a $500,000 home, the monthly break-even rent is just over $2,000. Now here's the key. If you can rent a comparable place for less than that, then renting is financially the smarter choice. In that situation, you're actually throwing away less money by renting. Wild, right? All right, let's dig even deeper into that single biggest unrecoverable cost, the one that's hiding in plain sight, the opportunity cost of your down payment. See, when you put a down payment on a house, you're not just buying a thing. You're making a massive capital allocation decision. That money is at a fork in the road. Path 1, it goes into your home's equity. Path 2, it gets invested in something like the stock market. And those two paths have led to wildly different outcomes historically. And historically, it's not even a close fight. Between 1992 and 2024, the S&P 500 returned over 10% a year on average. U.S. real estate, just 5.5%. By tying your money up in a house, you are consciously choosing a significantly lower historical return on what is probably the largest investment you will ever make. And it doesn't stop there. When you finally decide to sell your house, you get hit by something called transaction friction. Closing costs, agent fees, taxes, all that stuff can eat up 8 to 10% of the sale price. On a $500,000 home, that's up to $50,000 that just vanishes before you see a single dollar of profit. It can wipe out years of appreciation. All of this leads to a really critical concept called the break-even horizon. Because of these huge fees to get in and get out, a home is often a financial liability for the first several years you own it. You typically need to live there for at least 7 to 10 years just for the home's appreciation to cover all your costs. If you sell before that, you'll probably lose money. Okay, so with all this hidden math and these long time horizons, how are you supposed to make a decision? Let's put this all together into a simple, practical framework that you can use right now. Here is your simple 3-point checklist. First, look up the price-to-rent ratio for your city. If that ratio is over 21, it's a huge red flag that renting is probably the better deal. Second, run the 5% rule we just talked about on a house you're looking at. And third, take the tenure test. Are you absolutely positive you're going to stay in one place for at least 7 years? But wait, what about taxes? For decades, tax deductions were a huge selling point for buying a home. But you gotta know that after the 2017 tax law changes, those benefits have really shrunk for a lot of people. The one massive tax advantage that's still around is for long-term owners. A married couple can make up to $500,000 in profit on a home sale completely tax-free. So what's the final verdict here? Well, there isn't one. The idea that buying is always better is just a myth. The right choice for you is a cold, hard calculation based on the math of unrecoverable costs, the specific conditions in your local market, and, critically, how long you actually plan to stay put. Which really leaves us with one last big question you have to ask yourself. After you've run all the numbers, is this house you're thinking of buying a true financial asset that's designed to grow your wealth? Or is it really just the price of admission for the lifestyle that you want? The answer to that question? Well, it'll tell you everything you need to know.